Welcome to International Financial Management. So far in this course, we have covered the foundations of options, how they work, how they are priced, how standard call and put options are used by importers, exporters, and investors to manage foreign exchange risk. Today, we take a step further into the world of exotic options. Exotic options are special types of financial derivatives that differ from regular options because of how their payoffs are designed, when they expire, and where they are traded. Unlike standard call and put options, exotic options are more complex and flexible and are designed to suit specific investment strategies and risk levels. Typically, these options are exchanged in the over the counter market, not on standardized exchanges, which highlights their customization possibilities. Now, let me show you a quick comparison. Look at this table. Payoff structure. In standard option, the payoff is simple. It is either a call payoff or a put payoff, but in exotic option, the payoff is much more complex. Strike price. In standard option, the strike price is fixed and known right from the beginning. In exotic option, this is not always the case. The strike price may be determined later, as in the look back option, or may depend on certain conditions such as the barrier levels. Trading venue. Standard options are traded both on exchanges and in the over the counter market, but exotic options are almost entirely traded over the counter. This is because they are customized contracts and cannot be easily standardized for exchange trading. Premium. Standard options generally have lower premiums. Exotic options, on the other hand, tend to have higher premiums. This is due to their complexity and the flexibility they offer in the tailoring payoff. Let us now look at the important types of exotic options one by one. Let us begin with the first type, that is the look back option. A look back option gives its holder the right to purchase or sell foreign exchange at the most favorable rate realized over the entire life of the option. This is its defining feature. You look back over the entire period and use the best rate. The key point here is that the strike price is not known at the beginning. It is only determined at the expiration date, based on the most favorable rate observed throughout the life of the option. This is fundamentally different from all traditional options where the strike price is fixed at the start. Because of this added advantage, the premium on a look back option is significantly higher than on a comparable traditional option. Let us now understand the key distinction between the look back options and the traditional option. In a traditional option, the strike price is fixed at the beginning. So whether the option ends up in the money or not depends on where the market moves by expiry. In contrast, a look back option works very differently. Here the strike price is adjusted later based on the most favorable rate observed during the life of the option. So effectively, the option is always set at the best possible level for the holder. Because of this built-in advantage, look-back options are much more valuable and that is why their premium are significantly higher than comparable standard options. Now let's talk about the look-back call option. The concept is simple. A look-back call gives the holder the right to buy the currency at the lowest rate observed during the entire life of the option. So the strike price is not fixed on the day when you buy the option. It is determined at expiry and it is set equal to the minimum spot price that occurred at any point during the holding of the option. Now, for example, if we take this particular graph, this is the time, the x-axis is the time and y-axis is the market price. Now we can see there is a lot of fluctuation. Now let's suppose this was for 50 days here. We have been given 50 days. And over this time period from 0 to 50, we have to see the best price for call option. Best price for call option, and this is going to be the lowest price over the entire holding period. Now, what is the lowest price over the entire holding period? This is the lowest price. Now, this is going to be the K. At the time of the expiry, we are going to look back and see the lowest price, and this K is going to be the strike price of the option. For a look back put, the buyer has the right to sell currency at the highest rate observed during the same period. Now, here we have a time here, and this is the market price. We are talking about the look back put option, which is the right to sell, and hence the best price for look back put option is the highest price that happens over the entire holding period. Now, if we see here which is the highest price, this comes out to be the highest price, and it is K. So, now after the expiry of the option, if we have to find out what is our strike price, then K will be our strike price. So, the seller benefits from the most favorable selling rate. Let us now understand look back options through three specific scenarios. Scenario 1. In a look back put, the strike is set at the highest price observed during the option life. Now, if the price keeps rising, the highest price occurs at the expiry itself. So, the strike price becomes equal to the final price or the market price at the time of expiry, and the payoff becomes 0. Now, compare it with the traditional at the money put option, which was initiated at the same time. Its strike price is fixed, say K, which is lower than the price at the time of expiry, that is at the time of the market price. Let's say the initial rate. So, here if we see, this particular rate is the look back put option strike price. And this is also equal to the market price at the time of expiry. So, in this case what happens is, it becomes a at the money option, where market price is equal to the strike price. Fine. Since the price has only moved upwards, this option also expires out of the money and gives 0 payoff. So, in this particular scenario, both options generate the same payoff, which is 0. However, the key difference lies in the premium. The look back option is much more expensive because it offers protection against unfavorable movement. But in a steadily rising market, that protection is never used. So, after accounting for the higher premium, the look back option results in the lower net outcome compared to the traditional option. Now, if we see here, even in the case of traditional option, the option will be either at the money or out of the money, and hence the payoff is going to be the 0. But the premium is lower, is very low than the look back option. Scenario 2. When the price or exchange rate falls steadily throughout the life of the option, the look back call does not gain any advantage. In look back call, the strike is set at the lowest price observed during this option life. If the price keeps falling, the lowest price occurs at expiry. So, at the expiry date, the strike becomes equal to the final price, and the payoff is 0. Now compare this with a traditional call having a strike price, say K, higher than the final spot price. Since the price has fallen, the option expires out of the money and also gives 0 payoff. Now if we see here, this is going to be the strike price for look back call option. Now here at this point, K will be equal to the market price and hence it will become at the money option. Even if we take the traditional option, it is going to be the same, that is it will be also at the money or out of the money option, because here whether it is traditional option or the look back option, the buy from the market only, not from the option. It is only during the volatility the look back option truly shines. With a high volatile rate, the look back strike will be significantly lower than the initial rate. For the look back call to be more profitable than a standard call, the difference between the minimum rate observed and the strike price of the traditional call must exceed the additional premium paid for the look back option. Now let us move to average rate options, called as ancient options. An average rate options make it possible to hedge a series of daily cash flows over a given time using a single contract. This is particularly useful for business that have ongoing recurring foreign currency transaction. The option holder receives payoff based on the difference between a predetermined strike price and the arithmetic average of daily spot exchange rates observed over the life of the average rate option. The average rate option generally have lower premiums compared to standard put options that depend on the spot exchange rates. This is because the average rate is typically less volatile than the spot rate. In average rate call option, if the average of daily spot rates is lower than the strike price, the option expires without value because there is no benefit in exercising. If the average daily spot rates is higher than the strike price, the option holder receives a payoff equal to the difference between the average rate and the strike price. In average rate put option, if the average of the daily spot prices is higher than the strike price, the option expires worthless because there is no benefit in exercising it. If the average of daily spot prices is lower than the strike price, the put option holder receives a payoff equal to the difference between the strike price and the average rate. Now, it is very simple that in the traditional options, what happens is we compare strike price, that is strike price, with the spot price or the market price at the time of expiry. Here the spot price is the market price. But here in the case of average rate options, this market price is replaced by arithmetic average of daily spot rates. Now let us discuss barrier options, one of the most widely used exotic options in practice. Unlike conventional options, Barrier options have payoffs that are triggered only when the price of the underlying asset crosses a preset level called the barrier. These options either activate, called as knock-in, or become null, called as knockout, depending on whether the asset's price reaches the barrier level or not. Now, why would anyone want a conditional options like this? There are two reasons. One is cost and precision. Barrier options are cheaper than the standard options because the protection is conditional. The seller charges less and they allow for precision, hedging, and you can restrict protection to the price ranges you actually believe are realistic. Rather than paying for scenarios you consider extremely unlikely. There are four main types. One is up and output, up and input, down and output call, down and in call, and there can be many more in this. We can have up and out call, we can have up and in call. Let us consider here few examples. Let us say we have up and out put. Here the option ceases to exist if price rises above the barrier. Let's take an example of a put option where strike price is 1.80 per British pound and the barrier that they have set in this option is $2 per British pound. This put gives the company the right to sell British pound at 1.80. However, if the British pound strengthens to 2 at any point before expiry, the option is nullified or knocked out. If the British pound strengthens enough, there is no longer any depreciation risk. So the option is no longer needed and terminates. Type 2 is up and in, that is knock-in option. The option comes into existence only if price rises above the barrier. Let's take the example of the call option. Barrier level is equal to 2 here, $2. Options come into existence if British pound rises above 2. If British pound remains below 2 before expiry, the option never comes into existence. The buyer is only interested in the call if the price shows strong upward momentum. If the British pound does not rise greater than, then there is no need for the option. If British pound does not rise to the barrier, expectation for future rise, the option becomes useful. Type 3, that is down and out call. Now down and out, which is called knockout, is the option that ceases to exist if price falls below a barrier. Let the call option be having a strike price of $1.80 per British pound and the barrier is $1.60 per British pound. The call is nullified if the British pound drops below 1.60. The logic is that if British pound weakens so much, the call is too far out of the money to be useful and the option terminates rather than becoming a drag on to the holder. There is another option which is called down and in, that is knock-in option. This option comes into existence only if price fall below the barrier. Here let us say the barrier level is $1.60 per British pound. This put option activates only if British pound falls to 1.60. The put becomes active only after the price falls to a low level so as to provide protection against the further call. Now, in order to make you understand this, let me just recapitulate it. Fine. So, you have a barrier. We have discussed the questions. You have a barrier which is 2 here, $2 per British pound, and another barrier is $1.60 per British pound. Suppose you are at this position. Fine. When I say up, that means the value of the British pound has increased. Fine. So this becomes up. Now in up we have two categories, knock-in and knockout. knock in and knock out. Knock in means option starts existing, comes into being, and here the option ceases to exist. Now when will it happen? Now if we say, if we talk about the call option and we see that the British pound is rising to 2. Now it has become a very precarious position and there is a possibility if it rises more further, then the call option holder will have to incur a heavy losses. So what he does he gets into knock in, right? So this is knock in, the call option comes to existence to hedge his risk. Now another problem is that if suppose we consider the put option here, it is the right to sell. Now it has already increased the price to $2. So it is increasing and we may also expect that it will increase further. So when it is going to increase, we are going to buy from the market. So there is no need to keep the put option now. So it ceases once it reaches the barrier point. So this option ceases. Fine. Now similarly, let's go down here. And here first of all it is a down case. The price of the British pound has gone down to 1.60. Now in this down case two things can happen. If you have a call option, you will feel that the price is already down and it is expected to go down further. So when you are feeling like that, you may say that why should I actually enter into the contract of option. So the option is going to cease. But if you talk about the put option, the prices are going down too much further and there is a possibility that it may go further down more. So the put option holder would like to hedge his risk and hence it will be in a knock-in position and the options will come to existence. Now another interesting option is the compound option. A compound option is an option whose underlying asset is itself another option. The primary instrument being bought or sold is not a stock or a currency directly, it is another option. Compound option has two expiration dates and two strike prices. The first set belongs to the compound option itself, the second set belongs to the underlying option. There are four types of options: call on put on call and put on put. Call on call is right to buy the call option. So let me illustrate the numerical example. Suppose you buy a compound call option today. The compound option has an expiry of 6 months and a strike price of 0.50. The underlying option is a call or on euro with strike of price of 1 euro is equal to 1.10 and expiry of 12 months. What does this mean? At the end of the 6 months, you have the right to buy the euro call option at the price 0.50. At 6 months exercise date, you check what is the current market premium on the euro call option with a 1.10 strike and 6 months remaining. If the market premium is greater than 0.050, you exercise the compound option and acquire the euro call at the bargain price of 0.50. If the market premium is less than 0.50, you let the compound option expire worthless. You don't need the euro call at the premium. Now it is like this. You consider one option for 12 months here and this option is call on euro. Now there is another option here, and this option is call on call option, right? They both are having different rights. Here it is right to buy euro at dollar 1.0 after 12 months, right? This is what this particular option is saying, and what this particular option is saying is right to buy this call option, right? This call option, the call option at the strike price 0.50. Now this 0.50 is the premium. So after 6 months, that is here, you are going to compare what? The premium. You are going to compare the premium of your option with the other existing options in the market, and if you will see whether your premium is more or premium is less. This is incredibly useful for companies with contingent exposures. For example, a firm that has a bid on a foreign contract and won't know the outcome for 6 months. If they win, they will need currency protection for the 6 months. If they lose, they need nothing. The compound option lets them secure the right to buy protection later at a known price without fully committing upfront. Let us now look at the participating forward contract, which is a hybrid instrument. Now we all know that in a standard forward contract, the buyer locks in a fixed rate and misses out on any favorable market movements. In a standard call option, the buyer benefits from the favorable movement but pays a premium. The participating forward combines elements of both. It provides a guaranteed based exchange rate and also allows participants to participate in favorable movements, all without requiring an upfront premium in most cases. Let me take the export participating forward example. The bank guarantees exporters a minimum base rate of $5 per British pound. Additionally, if the exchange rate appreciates above $5, the exporter participates in 50% of any gain above the base rate. So, if the rate rises to $5.50, the gain above the base rate is 0.50. The exporter receives 50% of that, which is 0.25. So what is the effective rate for the exporter? It is $5 plus $0.25, which gives $5.25 per British pound. This is better than the guaranteed base and provides a safety net at the same time. If now market rate falls to 4.50 per British pound, exporter receives guaranteed base of $5 British pound. Floor fully protects. Now our final exotic option for today is the basket option. A basket option provides a hedge or speculative opportunity on the performance of a group of currencies rather than a single currency pair. This is very practical for multinational firms that have exposure to multiple currencies simultaneously. Instead of buying separate options for each currency, the firm may buy one basket option. Their payoff is based on the collective weighted average performance of all currencies in the basket against the base currency, typically the US dollar. At expiry for a basket call, if the weighted average exchange rate of the basket exceeds the strike price, the option is exercised. For a basket put, if the weighted average drops below the strike price, the option is exercised. Let us now work through the basket option numerical step by step. Now consider a basket call option that includes both Euro and Japanese yen versus USD. The weights given is 50% Euro and 50% Japanese yen. The option specifies a weighted average exchange rate as the strike price given the initial exchange rate at the time of purchasing the option. The strike price is set in a way that reflects an increase, a 3% increase in the weighted average value of the basket currencies against the USD. So, we have been given amount which is 1 lakh, premium 1000, expiry 1 year, and the Japanese yen as well as the euro has 50% weight. Now, what is the weighted average exchange rate? Weighted average exchange rate. As we know, we have been given the current rate where euro is equal to $1.10 and Japanese yen is equal to $0.0091. So we find the weighted average here. So this will be equal to the weight into 1.10 for the euro part plus 0.50 into 0.0091 for the Japanese yen part, and this will give us 0.5546. Now, the strike price which is given to us, these are the given things to us. The given thing to us is strike price is going to be 3% above current weighted average rate. So, this is our average rate. So, what is going to be the strike price? The strike price that we are going to calculate is equal to 0.5546 that we have got as the weighted average exchange rate into 1.03. This gives us 0.5712. Now, third thing comes is we have to new weighted average rate at time of expiry. And how are we getting these new things? First of all, we have the euro USD exchange rate has changed and it has become 1.15, and the Japanese yen exchange rate has also changed and has become 0.0095. Now, we have to calculate the new weighted exchange rate, and with this the new weighted exchange rate is equal to 0.50 into 1.15 plus 0.50 into 0.0095. This gives us a value of 0.5712. 98. So we can consider this is like a market price and this is our strike price. Now we have to calculate that whether it is in the money or out of the money. So here we know that the strike price, which is 0.5712, this is the strike price, is less than 0.5798, which is the market price, and hence it is the in the money option. We can buy at a lower price than the market. So this is actually a basket call option. Now that's all for today. I hope you understood exotic option, and we'll meet in the next lecture and we'll be discussing about other types of exposure and how to hedge those exposure. That's all for now. Thank you so much. See you in the next lecture.